The market is currently signaling a move toward more soybean acres, projected at 85 million, which has pushed the soybean to corn price ratio to 2.4. Historically, this ratio tricks farmers into thinking beans are more profitable. But this ignores the fact that a wall of supply from a record Brazilian harvest is already hitting the global market, likely capping any further upside for U.S. beans. The One Big Beautiful Bill Act has fundamentally changed the math for corn in 2026. The corn floor. The projected insurance price for corn was discovered at $4.62. The subsidy shield. With the new 80% federal subsidies on SCO and ECO, you can now protect up to 95% of your expected revenue for a historically low premium. The result, on a high-yield farm, a 95% guarantee on $4.62 corn often yields a higher worst-case scenario check than the best-case scenario for $11.09 soybeans. The consensus argues that corn is the diva. It needs perfect conditions, and beans are the adapter. While true, if you have the equipment and the history, the 2026 insurance levels actually reward you for taking the agronomic risk of corn. The crowd is fleeing to soybeans because they are afraid of the fertilizer bill. By staying with corn and stacking high coverage, you aren't just planting a crop, you are buying a government-backed revenue guarantee that the soybean market cannot match. Farmers need to stop treating soybeans as a low-cost alternative. If you are moving to beans solely to save on upfront cash, you are trading a massive, government-subsidized revenue floor in corn for a crop that currently has no floor and is facing a wall of supply from record Brazilian production. As the herd moves to soybeans, they are capping the upside potential of that market through oversupply. By sticking with corn, you position yourself to benefit from any domestic supply shocks while remaining fully protected by the 95% revenue guarantee. You are essentially betting on heads I win, tails I don't lose scenario.